Joining us right now to talk more about the deal is Devin Ryan. He's financials analyst at JMP Securities. Also, Mike Santoli, our very own senior markets commentator. Our guest host today is Jason Trennert. He's with Strategas Research Partners, the head there. And Devin, let's talk about what this means for the industry that you cover. What happens post this? I know the deal's just out today, but what can you kind of figure might happen from here?
Sure. Well, clearly you're putting together two of the best brands in the industry. So, Schwab, kind of the leader in the space, and then Ameritrade, for active traders, and especially on the option side, really has the best platform. So you're putting together a great advice-based platform in Schwab, a great active trader platform, and it looks like a good deal. I think our first glance here is 15 to 20% accretion by year three. It looks maybe a little bit conservative. The expense savings seem reasonable, but I think on the revenue side, they're not giving a lot of details, at least in the press release, and I suspect there's going to be more there. So probably a little bit under, promising over deliver is what we're going to see here, and I think it looks like a good deal from our first glance.
Watching TD Ameritrade shares, obviously they were up last week initially on news of this deal potentially getting done, but watching them this morning, they were up 4%, down a few percent, back up 2% right now. What do you think that is?
Yeah, I think people are trying to make sense of essentially what the accretion is. It's a long integration, so it's a year and a half to 3 years. So I think that's part of it, that it's going to take a while to get there. But again, I also think that they're leaving themselves a lot of room here to get this right. You have two big platforms. It's a big deal to execute. So leave a lot of room, probably go a little bit heavy on expenses in the beginning, and then don't overpromise on revenues. But my sense, again, is that if it's only 15 to 20% accretive, that's a headline number. I think it's probably something decently better than that. So they're kind of trying to leave themselves some wiggle room here for some pricing action, or just to kind of move a little bit slower.
So the proximate cause of this obviously is zero commissions. And can you just, for as someone who runs an institutional brokerage, it's hard to, zero doesn't really, I can't quite understand how zero works. It still costs you something to execute the trades, 30 mils or 35 mils. What is it precisely? And I'm sorry, I should know this, but how does that work? Or is it just you make it up on volume, or what's the?
It's a good question. So it's a scale game. So you have to have scale to be able to deliver that type of pricing. So you make a little bit of money on payment for order flow from the market maker, so they're paying a little bit to the brokerage firms for the execution. Then you're making small amounts on margin lending to the client, transaction costs elsewhere in the platform, getting paid a little bit from third-party product manufacturers to be on the big distribution platform that they have. So you're making a couple basis points here, a couple basis points there, but when you have $3 trillion, now $5 trillion in assets with this combined deal, you can make it up even on small margins.
Is it sustainable, though? Is it something where after the consolidation is over, will the pricing no longer be zero?
I don't think so. I actually think that, what we're talking about this morning, you might get more pricing reductions here. Because you think about it, Schwab, Ameritrade, they're operating at almost 50% operating margins. So everyone talks about trading costs coming down. Trading costs were a lot higher 20 years ago, and their operating margins at a firm level were a lot lower.
And how much are individual trades still the game? I mean, I was looking.
Schwab, it was 7%.
7%, only 7% of the business.
As a separate company, more like 25, I think, for Ameritrade. So no, it was it's kind of like, well, banks give you free checking,
right?
Not because it doesn't cost them anything, but because the relationship, they earn it elsewhere. So I think it moved well beyond that.
What is your sense of the antitrust issues around this? And the reason I was looking for to see if there was a breakup fee. They have not published the breakup fee. I have to imagine there is one, because I would think this is going to be something that people are going to look at.
Yeah. We talked a lot about it with clients last week. It's a great question, because you have two firms that are going to be over $5 trillion in assets, but we were talking about this last week. It's very fragmented in terms of the overall pie they're going after.
It depends how you're defining the market, though.
That's right.
There's multiple ways to define the market. By the way, you look at RIAs.
Well, that's the part of it, to me, where there's the most concentration on paper.
On paper, it's what, 75%?
Right.
That's real.
75% of that particular business, right? That kind of custody for independent RIAs. But Fidelity's a big competitor. What's interesting is that probably if you polled the investment advisors themselves, they'd be like, this is great, because they're probably going to be that much bigger, and they can give me a better platform and all the rest of it. But I wouldn't be surprised if there's some scrutiny there. But in general, the overall market for retail investment services is so vast, and it's so driven by these cost competitive players like Vanguard and Fidelity. I don't know if it's necessarily, especially under this current regulatory posture, if that's going to be an issue.
Yeah, you probably have 10% of the overall addressable market in this deal here, so it's not a small number, but that's a number I think that can be overcome. And then ultimately, a lot of antitrust issues are around what happens with the customer. The customer has been treated very well here in the industry as pricing's come down, and I think that this is an opportunity where pricing could come down even more. So I think that's something that will also be looked at, and I think the customer, whether it be the retail customer or the RIA, is a winner of a transaction like this.
Mike, what do you think happens next with the rest of the industry?
I think that, you have an E-Trade floating out there. It looks really small relative to the rest of them. So I think there's obviously a little more of an impetus for another round of potential consolidation. But I think it's more to the point, the direction of the business is going to be toward everything's going toward as close to zero as you can in terms of actual out-of-pocket cost. And what I think is interesting about Ameritrade, Schwab, this whole business is they were founded on the premise of undercutting the incumbents and getting cheaper and delivering more and making it more technology-oriented. That's why it's different to me a little bit than when Merrill Lynch was trying to defend this moat and our other full-service brokers of their pricing, because these guys have lived in this world of just keep making it cheaper for the customer, and we'll hopefully make it up on the back end. I think, when Schwab went down below $30 a trade, it's more than 20 years ago, was a big deal for online trades.
Devin, we got to go, but very quickly,
Yeah.
Who would a buyer potentially be for E-Trade?
Well, you have two of the biggest firms here kind of tied up for a little bit. I mean, they still in some ways make sense. So is there any way, we'll see how this deal starts to progress, but whether they could come back around and E-Trade would still, I think consolidation in this group still makes a lot of sense. But people look at some of the big banks, or whether it be Goldman Sachs or Morgan Stanley. I mean, those are the types of names that get thrown out. But consolidation makes sense. And by the way, trading is free, but it's a commodity. All the parts of the business that are commoditized in any industry that over time the pricing comes down. So the parts of the industry that these firms are going to be able to charge for are the advice-based, non-commoditized pieces, and that's where I think they're all going right now.